Hi. Mutual funds have become quite a popular way of investing money in the stock market. With convenience, flexibility, diversification, and professional portfolio management, the benefit seems endless. Therefore, while mutual funds might seem like the best course for investments, it is important for all of us as informed investors to understand all the concepts of net asset value or the NAV and the taxation for this asset class. So in this video, we will understand the following aspects of a mutual fund: its valuation and pricing and its taxation. The valuation of a mutual fund is done by calculating its NAV or the net asset value. So what is the NAV? To put it simply, the NAV of a mutual fund is the market value of a mutual fund. If the NAV of a mutual fund is rupees 100, you will have to pay rupees 100 to gain 1 unit of the mutual fund. It is essential to remember the following things when it comes to the NAV. The NAV is always calculated unit-wise. Next, it changes on a daily basis. And a higher NAV usually implies that either the scheme has been investing in the market for a longer period than other schemes, or that the scheme has outperformed and its investments have prospered over the years. Now, while the NAV is not the only factor we should consider while making our investment decisions, it is an important point to note as to what does an NAV implies. So, the formula to calculate the NAV is net assets of the scheme divided by the number of units outstanding. Now, the NAV is either calculated by the AMC itself or a SEBI authorized firm chosen by the AMC. Now, let us talk about the taxation, which is the next important part. A mutual fund provides two types of returns to the investors: capital gains and dividends. It is important to note here that a fund house is exempted from tax on its income and earnings under the provisions of sections 10 subsection 23D of the Income Tax Act 1961. Therefore, all the capital gains are taxed in the hands of an investor. A capital gain occurs from the trade of the units of a mutual fund, and it is of two types. First is long-term capital gain, which is LTCG, and next is short-term capital gains, which is the STCG. The taxes applicable on these are known as capital gain tax. So when it comes to LTCG, which is the long-term capital gain taxes, all gains exceeding rupees 1 lakh earned from securities held for more than 12 months are taxable at the rate of 10%. Now, when we talk of STCG, which is short-term capital gains taxes, they are charged at the rate of 15% for all the gains, only for those securities which are held for a period of less than a year or 12 months. Additionally, we also have the Securities Transaction Tax, which is the STT. This is charged on the sale of equity and balanced funds and is also borne by the investors. Now, there is a charge of 0.1% on all the delivery-based transactions with equity mutual funds and ETFs, while there is a charge of 0.025% for all the non-delivery-based transactions. Now, coming to the dividends. Now, there is a dividend distribution tax, which is known as DDT, which is levied on the payment of dividends, but it is borne by the AMC instead of the investors. All equity schemes are charged at the rate of 10%, whereas the debt schemes are charged at the rate of 25%. After charging all these, a surcharge of 12% and an education cess of 4% will also be levied. That's all in this video. Thank you for watching.
Investment in the securities market are subject to market risks. Read all the related documents carefully before investing. Such representations are not indicative of future results.